One trust sale mistake triggered a $300,000 tax bomb. After saving clients millions of dollars in trust property transactions, I'm sharing the tax loopholes most CPAs miss. The strategy later in this video could save your inheritance. Selling property held in a trust after someone passes away in Florida comes with a host of tax considerations, and understanding them can mean the difference between maximizing value and getting hit with unexpected tax liabilities. If you're a trustee or beneficiary handling a trust property sale, this guide will break down what you need to know about the basis setup, capital gains, estate tax, trust distributions, and tax exemptions so you can navigate the process with confidence. First, let's start with one of the biggest advantages when selling inherited property, the basis step-up. Normally, when you buy property, the amount you paid for is the cost basis, and when you sell it, any gain above that amount is taxable. However, when a property is inherited, the IRS allows what's called a step-up in basis, meaning the property's value is adjusted to its fair market value at the date of death. Why does this matter? Because if the property has appreciated over the years, this step-up significantly reduces capital gain taxes when it's sold. Let's say your parents bought a home decades ago for $100,000, but at the time of their passing, it was worth $500,000. If they sold it before passing, they'd owe capital gains tax on the $400,000 increase in value. But if you inherit it and sell it right away for that same $500,000, there's no taxable gain because of the step up in basis. That's a huge tax saving advantage. However, if you hold onto the property and it appreciates further, you'll own capital gains tax on any increase beyond the step-up value. Capital gains tax is another factor when selling property from a trust. When an individual sells property, capital gains tax applies to any increase in value since the purchase. In the case of trust property, whether you owe capital gains tax depends on how the trust is structured. If the trust is revocable, meaning the grantor still had control over it until they passed, then the beneficiaries get the step up in basis. If it's an irrevocable trust, the tax treatment can vary and capital gains may apply differently. The key is understanding how the trust was set up and whether the property was included in the decedent's taxable estate. Now let's talk about estate tax. Florida doesn't have a state estate tax, but the federal government does impose one on large estates. The good news is that most estates don't hit the federal threshold, which in 2024 is around $13 million per individual. If the estate tax is below that, there's no federal estate tax due. However, for high net worth individuals, estate planning strategies, including trusts, are often used to minimize potential estate tax liabilities. Timing of trust distributions is also critical when selling property. If the trust allows for immediate distribution to beneficiaries, they can decide whether to sell the property themselves, often taking advantage of the stepped-up basis. If the trust retains ownership and sells the property first, it's the trust, not the individual beneficiaries, that may owe capital gains tax. This is why property trust administration is crucial, as distribution timing can have a significant impact on tax liability. Understanding tax exemptions is another way to minimize tax exposure. One of the most common is the home sale exclusion, which allows individuals to exclude up to $250,000 or $500,000 for married couples of capital gains on the sale of primary residence as long as they lived in the home for at least 2 of the past 5 years. Unfortunately, this exemption doesn't apply to trust-owned property unless the trust was structured in a way that allowed the beneficiary to live there as their primary residence before selling. Filing requirements also play a role in the trust property sales. If the trust sells the property, it may need to file a fiduciary tax return, which is Form 1041, and may pay any capital gains tax due before distributing proceeds to beneficiaries. If the property is distributed to beneficiaries first and they sell it, they will report the sale on their personal tax returns instead. This distinction is important because trust tax rates are generally higher than individual rates, so timing the distribution properly can lead to tax savings. Finally, let's touch on state tax matters. Florida doesn't have a state income tax, which is a major advantage for selling trust property. However, If the beneficiary resides in another state with its own income tax, they may owe taxes on any gains recognized from the sale, depending on their state's tax laws. Selling a property from a trust in Florida is more than just signing paperwork. It's about understanding tax laws, maximizing benefits, and minimizing liabilities. If you're dealing with this situation, consulting with a tax professional or estate attorney can make all the difference. With the right strategy, you can ensure that the trust property is sold in the most tax-efficient way possible, preserving more of the value for you and your family. Thanks for tuning in, and if you have any questions about this or other legal topics, drop them in the comments below. Don't forget to like, subscribe, and share this video if you found it helpful. Until next time, stay informed and stay protected.